we're going to discuss the differences between a loan and a withdrawal. Too many times in the industry, we use the wrong terminology, such as we're going to take money from our policy, or we're going to borrow from our policy. We're going to use the cash in our policy. We use these terminologies because as agents, we may not be educated, and as consumers will watch other individuals' content that just may not be using the right and correct terminology. Now, at the end of the day, it's not that big of a deal of how we use our words. What really matters is how we're able to use our dollars. If we're able to borrow against our cash value, which is the correct terminology, borrowing against, because what we're doing is we're using our policy as collateral, and the insurance company is giving us a loan to then be able to use our dollars. And that's how we're able to get our dollar to do two things for us at once. If we're actually using our dollars in the cash value, if we're actually using our dollars and withdrawing them and taking it from and borrowing from our policy, well, then it operates more like a 401k, and it operates more like any other asset class where we're actually using those dollars. And once we pull money from our actual cash pot, well, then we're killing the goose that's laying the golden egg. Because if I have $100,000 of cash value and I withdraw $50,000, well, instead of getting $100,000 of compounding interest, now I'm only getting $50,000 of cash value being compounded. So what we want to do is borrow against, leave our cash value alone, let it sit there and compound, and then use that $100,000 as collateral and get a loan from the insurance company. Because when we get a loan from the insurance company, it's now considered a non-taxable event. Why? Because the IRS says, hey, debt, that's not taxable. And so our cash value can grow deferred, tax-free. It can grow tax-deferred, but then we can access it tax-free and use it tax-free if we're borrowing against our policy and using it in that format. And so what I want to do is I want to share with you the differences between a withdrawal and the differences between a loan. Because when we're able to understand the differences, well, then we can go in with a better strategy to be able to borrow against our dollars, to be able to use this policy in an effective way to then get a better rate of return, not from our policy, but to be able to have our overall portfolio be more efficient because we're not paying taxes. We're not killing the goose that's laying the golden egg, and we understand the arbitrage from what we're borrowing against to the activity that's going to produce the higher rate of return for us. And if that's our real estate, our business, investing in ourselves, those are the things that are most important. So what I'm going to do is I'm going to go ahead and over here, and I'm going to share my screen, and I'm going to go ahead and share with you the differences between what a loan is and what is withdrawing. So first of all, when we do a loan, the loan is going to have a borrowing rate. So you're going to have a rate. This rate can, let's just say, vary from 4 to 5%. Currently, this is what your borrowing rate will be at. If you withdraw, you have no rate. There's no loan rate because we're not actually we're not getting a loan. We're actually pulling the cash value. So when we're using the loan, there are no taxes involved because when we borrow, it's considered debt, and the IRS does not have that as a taxable event. When we withdraw, you have potential for taxes. Now, when I say potential taxes, what this is essentially saying is that if I contribute dollars into my policy, whatever I contributed, I can withdraw tax-free. But if there's any growth on the policy, well, then now I have to pay taxes on that if I use it. So if I've put in 100K. So if I put in 100K, if that came out of your pocket that you've contributed, my policy grew to 150K. I have to pay taxes on 50K. So I put in 100. My policy grew to 150. So I have to pay the difference, which is 50K in taxes. And that's going to be at ordinary income. So depending on what your income is for that year, you're going to have to pay taxes on that. In this side, with the loan, there are no taxes that you have to pay. Now, the only way that you'd have to pay taxes on the loan side is if your policy lapsed. So if you essentially were at a place where your policy canceled, you canceled it, or your loan value became more than your cash value and you had to surrender. And surrender is just another way of and canceling is they're all synonyms for each other. Well, then it goes back to the withdrawal standpoint where you don't have to pay taxes onto the money that you contributed, but you do have to pay taxes on anything above the amount that you put in. So the whole objective when it comes to a permanent insurance product is we're going to take loans, especially at the beginning. There are going to be ways where we're going to take withdrawals, and I'll talk about that a little bit later. But loaning is the strategy that we're going to use often to use it to where we don't have to pay taxes on it. And this is going to be something that lasts our entire life. And as long as the policy is in force and as long as the policy is intact, we don't have to pay a tax bill on that. So those are going to be some of the main nuances. And then the other main nuance is that uninterrupted compounding. Interrupted compounding. And on this side, you do interrupt compounding. Interrupt compound. Now, what I mean by that is on this left side, if I have 100,000, same scenario of cash value, this 100K is going to get the full dividend and full guaranteed compounding no matter what happens, even if I take a loan. So if I take a 50K loan and use this 50K for real estate, I am not going to get compounding interest on just 50K. I'm going to get the compounding interest on the full 100K. So I'm getting 100K getting compounded, and I'm taking this 50K and I'm getting my dollars to work for me for real estate. So I have 100K getting a rate of return, and I have my 50K also getting a rate of return. Let's just say 15%. So this is how you get your dollars to do multiple things at once. The cash value stays compounding intact, never being interrupted. And I now have my dollars doing two things for me at once. Now, when it comes to the interrupted compounding, if I have 100K and I withdraw 50K, I now only have 50K in my policy getting compounding. So when it comes to the compound, it goes from 100K to 50K. So now my compounding becomes less, and I can now still take that 50K and do it for real estate. So both instances, I have 50K working for me in real estate, but what ends up happening is I now have less dollars compounding in my policy because I actually withdrew that cash value, right? So we don't want to take a withdrawal. What we want to do is we want to take policy loans, especially in the earlier years when we're trying to build wealth, when we're trying to use it for a function of opportunities to be able to grow. So what we don't want to do is we don't want to miss out on the lost opportunity cost of our dollars. That's the whole thing of the AND asset. We can have our dollars do two things at once, and we can recapture all of the interest that we would have lost if we would have been able to, if we would have actually withdrawn it and use it for something different. Now, there is a time when we would take a withdrawal and where it becomes more efficient. And a lot of times it's in our later years in our life when we're in 70, 80 years old. And what we're wanting to do is we're wanting to use it for retirement. We're wanting to use it for cash flow in retirement. And it's not, at this point in time, we're not borrowing to try to get an arbitrage for, using it for real estate, for business, for so on and so forth. We're wanting to withdraw all of our funds to be able to use for a lifestyle, for vacations, for fun, for your bills, so on and so forth. And what we'll do is we'll take a withdrawal up to our basis. And when I say basis is just the money we put in. So same instance that I talked about up here. If I put in $100,000, okay, we would withdraw $100,000 from the account. So let's just say let me just use a better example. Let's just say over here, we had $800,000 of cash value, okay, total. That was what we had. But we contribute 200K, okay? So over the 30 years, 40 years, 50 years, whatever length of time it was, we've contributed 200K. But my cash value is 800K. We would withdraw this 200K. So what would it do? It would bring this 800K down to 600K. Then what we would do is then we would take loans for the remainder of the 600K. Why? Well, we don't want to pay taxes on this concept no matter what. And so if we're able to use a strategy where we can take a withdrawal and then afterward take a withdrawal, then borrow the other 600K, right? Now we'll then switch over to the strategy over here, right? Where we're now taking loans on this 600K. Well, then we can use them both together for retirement. That becomes a very efficient strategy, is taking a withdrawal up to the basis and then borrowing up to everything else above that. And so that's kind of how you can work them together. But that would be the strategy we'd use in retirement when we're looking at it from a cash flow perspective. So I hope this helped to give you a very clear understanding of the differences between loans, withdrawals. I know a lot of people are confused of, hey, what's the difference? How can I use my cash value? What does that look like? So I just wanted to share this with you, and please comment below in the bottom if this helped. Please like, subscribe, and if there's anything else that you want to learn specifically, please share, and I'd be more than happy to go ahead and educate. Thanks again for watching, and until next time.